friends. Welcome back to the Skinny on Wall Street with Kristen and Jen. This is Kristen.
I'm Jen.
And this is our second weekly podcast episode where we give you the skinny on random things going on in the markets and anything that happens to be on our mind. And today we're going to get into CPI numbers and what that means for inflation, for the expectation of rate cuts and all that kind of fun stuff. And I also want to do a continuation of the Paramount. See, I said it right, Jen. The Paramount.
You did say it correctly there. Good job.
Because the deal that was initially on the table and everyone thought was going to go through is officially dead, which
it is. I can't wait to get an update.
Yeah. So we're going to talk a little bit about that and also tie it into what we have coming up with our course, because Jen and I have been knee deep, like just in the weeds with trying to produce this thing. So we'll fill you in a little bit on kind of how that's going and what's up.
But Jen, it is not going well. I spent all morning battling with technology for the 11th day in a row. But wait, before we talk about any of this, little bit of housekeeping / big announcement. It was Kristen's 40th birthday this week. So if you're listening and you follow us on social media or you email with us or any way that you communicate with us, please wish Kristen a very happy birthday. A very exciting milestone.
It's wild how I'm not one of those people. When I got married, it didn't feel different. Like certain things, but there's something psychologically, like 40, it just feels like, oh my God.
It's funny because for me, it's about the brackets, right? Mentally in my mind, I'm in the 25 to 39 bracket, right?
Yeah.
I don't want to move to a different bracket. I liked being in that bracket. I was comfortable in that bracket. I just don't want to be in a different bracket because I don't identify with people in that bracket mentally. We are preparing not only for our course, but also for our upcoming episode where we're doing season 3 of Succession. It was Kendall's 40th birthday party, right?
Yeah.
And I remember watching that season when it came out just a few years ago and being like, 40, I wonder what that like. That's so far away. That couldn't possibly apply to me. And now I'm like, oh my God, I got to plan my own 40th birthday party, which will not involve me being nailed to a cross in a tuxedo singing Billy Joel.
Yeah, seriously.
Which is what he was
I'm so excited for that. Yeah. Well, I do think that when you're young, right, you see people who are older and you think that they're just different. And it's like, nope, they're exactly the same.
We used to think they were like smarter or wiser or knew what they were doing. The jig is up.
Well, I do think that the one thing that you get
in my own life.
Same, but the one thing you do get, I think, is just confidence, and you start giving less shits about things. We've talked about this before. Like that is, I think, the biggest gift. And your network gets so much bigger. And the network that you have, where it was like your drinking buddy from college is now the CEO of some like ridiculous company. And so it is kind of crazy how it's like, your peers are super impressive. And we get people on our podcast and we're like, holy shit, you were my summer analyst. And so there is something that's like really cool about it. I look back at sort of my 20s and my 30s and like, again, like if I could go back and do it again, I wouldn't. I'm much happier where I am now. When I was in my 20s, like you're working so hard, you're going out, it's like kind of exhausting. You're meeting people. I freaking hated dating. Like I hated that. And then in your 30s, like, I mean, you're having kids, and again, kids are wonderful, but like being pregnant, I hate it. Like pregnancy is my least favorite thing. And so to kind of be on this other side where we've started this business together, which has been like so fulfilling. I mean, it's been the best thing to happen.
Technology part.
Except for the technology. We won't. Yeah. But to be in this place now where we have left New York City, we've settled in a home. So I'm so happy with everything. And again, I wouldn't go back, and people seem to think like when you hit these new milestones. Yeah. But again, I mentally still am in my 20s because I feel very immature. I'm still like kind of a mess. You know what I mean? Like all those little things. Like it's like I need my parents to get stuff. I literally today needed like chicken. I needed to go grocery shopping. And I was like, can you go to the grocery store for me? Like do the stuff that as a parent, it's just, I don't know. I think that you grow up, but like you're always a little kid. I think everyone's always like, I still just need help. Anyway, so that was my 2 cents on turning 40, but I feel the same.
You're doing a great job of it. And if I look half as good as you and I turn 40 in 6 months,
Shut up.
I'm very happy.
Why don't we start with our just discussion of the Fed? Well, not the Fed. Sorry, our discussion of what's going on
Inflation
with CPI
data. I got
and the
you.
inflation data.
We'll,
Yeah. You know what I mean?
We'll leave you in your mental acuity
Yeah.
where you're 39. So
Yeah.
we've had a slew of inflation data this week, and we had the regularly scheduled Fed meetings. We had CPI, which is the consumer price index, yesterday morning. We had PPI, which is the producer price index. Obviously, consumers and producers are two sides of the chain of selling things to one another. And both of those measures of inflation were lower than expected. And in fact, much lower than they've been for intervals of several months, if not several years, as we've been in this tightening monetary policy environment. And so even though the Fed yesterday was somewhat hawkish, the markets are now pricing in more than a 50% chance of 2 rate cuts this year. The Fed seems to have committed to only one. And when I use the term hawkish, have we gone over hawkish and dovish before on here?
I don't think so.
If we have, I apologize for the review, but if we have not, just
in fairness,
really
Jen, I
quick.
don't think people listen to every single episode. So
What? This
I know,
is
shocker.
brand new information. Well, for those of you who may not be assiduously studying every second of the Wall Street Skinny, just to recap, when we talk about monetary policy, there's 2 avian descriptors that we use to describe how the Fed is behaving towards monetary policy. The term hawkish refers to being focused on controlling inflation. I always think of exactly Kristen's flapping, but I tend to think of a hawk, which is a carnivorous bird of prey swooping down from the sky in order to keep a dampening impact on the economy and keep it from overheating. And dovish, you think of doves as like bird of peace. They're like, why don't we all just get along?
Yeah.
Everything's great. And so hawkish, oh my God, speaking of which, there's like a National Geographic scene happening right outside my window. There's a crow and a chipmunk fighting. Anyways. So the crow is not on the menu, but hawkish monetary policy tends to be when the Fed is focused on tightening monetary policy and raising rates or keeping them high. Dovish monetary policy is when they are focused on promoting growth and easy monetary conditions and potentially cutting rates. So language out of the Fed yesterday indicated they really only have 1 rate cut on their minds for 2024. The market
They expect any? Wow.
Yeah, no, they do. But the market is overruling them and saying we think it's a higher likelihood that there's 2. So 5s and 2s have been leading the way, rallying over the past 24 to 36 hours. And that means rates are going down, prices are going up, and that's indicative of the market pricing those higher odds of Fed cuts back in after they were taken out.
I don't know. I just like always find it crazy. I'm like, why are we dropping? I mean, again, I would love to have rates go down because we have our house.
But it's a quarter of a point. Like
I know that, but like why?
Basis
but
point.
why? Like why? I mean, we're not even at 2%. Like we're not at their freaking goal. So it's like, why are you dropping rates? Like I would love it. We are one of the people that are in the non 2% mortgage buckets, right? Like we got our freaking mortgage well into like high rates, you know, but I just don't we're not at 2% inflation. I don't know. I just don't see why you would start to lower rates when it's not necessary yet. It feels like that's a tool you should leave in your tool. It's like having a credit card and maxing the credit card out and then being like, oh shit, I can't use it anymore. Like you have this tool that if things go bad, you can start lowering. Like, why would you do it before it's needed? I don't know.
It's interesting.
Weird.
I mean, I think you talk to most experts out there, and none of them think we're getting to 2% anytime soon.
True.
Or
I've seen that.
Possibly ever again. But the other thing is that so often the Fed's hand is forced by the market, and the market will lead the way regardless of what the Fed says that it wants to do. And we've had these conversations
because it's about expectations versus actually what they do, or like why? I mean, it just seems like, again, the market's doing well because the market believes that it's going to price in. Like, it seems like they get the benefit from just doing nothing and letting the market think that it's going to happen, and then it doesn't. But like, I don't know. I just, we still have equity's on it. Like, I just don't get it. Why would you start? I've thought this like since the beginning. I was like, they're going to start dropping rates again. I mean, rates are from historical standards, like 5% isn't, but they're not crazy high. And I go back to my understanding of kind of the history is colored by my parents who got a mortgage at like 18% or something insane in 1980s.
That's not colored by. That's just you have an understanding of history.
Yeah, that it's like how
You've
high
looked at
it
a graph
can go.
that's longer than 15
True.
years.
Yeah, so it's like the 0% interest rate environment that we were in for the last 15 years is not normal. And it just feels like everyone's like, well, we're going back to zero rates again. And I'm like,
no, I don't think anyone thinks that we're going back to zero rates again. But what is really interesting is there was a study that came out. I think if
Trump gets in office, people think that, but yeah.
There was a study that came out about 3 weeks ago. Did you see this? That more than 2/3 of Americans think we are in a recession right now.
Oh, yeah. I did.
That there's a huge dislocation between what the average person thinks and perceives and what the actual statistical data is. Like, and this isn't like some unknowable thing, right? If you look up GDP numbers, if you look up anything, right, it's a binary thing, right? Whether or not we're in a recession. And so I think it's really.
And by the way, do you want to just tell our listeners what it technically means to be in a recession?
Yeah, that's such a good question. So the rule of thumb that I was always taught was it needs to be 2 consecutive quarters of decline in GDP growth. But I actually think that it's much more complex than that. And I do believe that in Europe, there actually is like a very specific formula. But a lot of U.S. economists will take a number of different measures into account. But the bottom line is we have not had anything close to 2 consecutive quarters of negative GDP growth. So we're simply not there.
Yeah, and unemployment is at all-time lows.
Although I just saw a headline today saying that some of the unemployment data is rising again, led by California, which I thought was interesting.
Oh, weird. Okay. So much of the stuff, it's how do we measure these things? And the thing that's like wild to me about inflation is that it's ignoring the cost of housing, which, by the way, it goes up when you raise rates. So it's almost like we're trying to cool inflation by making it more expensive for you to own a home or do all this stuff. Does it exclude food too? Or no, it includes food.
Well, so there's a number of different inflation metrics, right? So there's headline CPI, core CPI, there's X food and energy, et cetera, et cetera. So if the Fed looks at all of these different measures broken out, right? So they tend to prefer the metrics that exclude the volatile things, right?
Right.
But that's
that they
where
can't control.
Well, that are idiosyncratic, right? In theory, that aren't impacted by the traditional transmission mechanism of the 3 tools that they have at their disposal, right? Reserve requirements, balance sheet, open market operations, and market rates, right?
Right. It doesn't matter what you do, you can't control if there's a war in a oil producing country internationally and the price of oil goes up.
That war is not going to be caused, hopefully not, by where the Fed funds rate is set. Right. Hopefully. I mean, I guess we can have a very philosophical conversation about that transmission mechanism, but I'd rather not. But yeah, so to your point, as an average American, you may be having some cognitive dissonance right now, where things feel wildly expensive and inflation feels out of control. Yeah. But you also feel like economic conditions might be too tight because it's very difficult to purchase a home right now because rates are so high. It's very difficult to fund your businesses. It's very difficult to, there are high interest rates are really impacting especially lower income Americans much, much more heavily than they are upper middle class and upper class and wealthy Americans.
If you own a home and you, again, bought that home pre-2020, now all that happened, and you have savings. You have higher savings. Oh, pre-2022, you're right, because that's when they started to raise rates. But you have a house, so the cost of your housing hasn't gone up. You have money in the bank that's probably earning now higher interest rates. The stock market's done great, so that's growing too. So everything is wonderful. But if you are a lower income household, then it hits you in a whole bunch of different ways. This is all depressing.
So rate cuts maybe coming soon to a theater near you. Maybe, who knows?
Oh, speaking of theaters, love how you did that because we're going to get into Paramount. So I actually want to back up a little bit. So we had talked about this deal in the past because it was a kind of fascinating discussion about dual class shares. So Paramount, they have a whole bunch of brands, like I think Nickelodeon, like MTV and Paramount Plus, all those kind of fun things. But there is National Amusements that Sherry Redstone, who was the daughter of Sumner Redstone, the granddaughter of Michael Redstone, who started it. She is the majority owner of this National Amusements, which owns the majority of the controlling shares in Paramount. Paramount and National Amusements have been in play. So there was this whole saga where Apollo was looking at buying Paramount. And by the way, so like this is where it gets complicated. It's like, is Paramount in play? Is National Amusements in play? Are both of them in play? And National Amusements, by the way, this is why I said the theater thing was kind of a great segue, is they own a bunch of theater companies: Showcase, Multiplex, Cinema Deluxe, et cetera. So they own 1,500 theaters across the US and the UK. So the deal that was almost towards the finish line, you had Larry Ellison's son, David Ellison, owns this company called Skydance. And so Larry Ellison, you've heard of him. He's like the 10th richest person in the world. He was the CEO of Oracle back in the day. And his son was interested in buying. It was this whole like weird structure where like they would buy National Amusements and like merge in Paramount with Skydance. It was this whole weird thing. And Sherry Redstone liked it because so there's these two classes of shares. There's Class A shares, there's Class B shares. And the Class A shares are super voting. And so she was basically like, she was the decision maker about whether or not these deals would go through, even though she had a teeny tiny fraction of the actual majority stake. And this is, again, where you get into like these weird things where there's super voting shares and there's non-voting shares and it can get complicated. But it was this like kind of sketchy, weird thing. Like she would get this huge payout and it was like, screw the other shareholders. Anyway, the other shareholders were not happy about that. Ultimately, I think she would have gotten like $2.5 billion for her stake alone. And they ultimately started to give a little bit more of the money to the other shareholders. The Class B shares are publicly traded. Like you and I could be owners in it. And that was this new revised deal structure. Anyway, she decided after a whole bunch of drama, by the way. So she like fired the CEO who didn't want this deal to go through. 4 board members resigned. It was Succession level drama. And there's a lot of parallels with Succession, which we're going to talk about. But it was this crazy drama. And then ultimately, after it was about to go through, she decides to pull the plug. And so there was a lot of speculation about why this happened. And there's actually a really great podcast out there called The Town. I just want to shout them out. And I listened to that because they talk about just the business of entertainment. And it's fascinating. I started to listen to it because, again, we're doing our case study on Gojo and Waystar Royco. And like, we need to have kind of the color on just the entertainment industry because of that whole part of it. Anyway, so they walk through like some of the reasons, like why the heck did this deal not go through? And one of the reasons is like, she was getting less money. So when this deal initially happened, she was going to get, like I said, like $2.5 billion. And then apparently she was, because they had to start giving money to the other Class B shareholders, she was then going to get less. So it was like less than $2 billion, which she didn't like. So that was potentially
I don't get out of bed for less than $2 billion.
Seriously. Yeah, seriously. The second reason was that the timeline for the transaction was just very long. So it was 12 months, maybe longer. And the other little like wrinkle that gets thrown in here is that there's going to be a potential change in administration. Like obviously we have no idea what's going to happen with the election, but I think she is like a Trump supporter. And obviously there was probably a higher likelihood that Trump would let some of these types of deals go through potentially. And so I think like they want to maybe just put a pin in it and see, can we maybe get a more favorable administration? There's also the lawsuits. So again, this whole situation with the different class of shares, like, I mean, look, most M&A, there's lawsuits. We actually had our podcast with Jake last week on M&A law and being an M&A lawyer. And the fact that these documents have to be airtight because in case there is a lawsuit, like there's going to be lawsuits with this transaction, whether this goes through or not, like there's going to be lawsuits. And then finally, there was a rumor that just one of the board members who happened to be, I guess, he ironically was actually on the Oracle board with Larry Ellison back in the day, but that he had been in Sherry's ear, basically trying to get her not to sell so that he could ultimately get put in as CEO. Now, again, this is all speculation. What's interesting about this is that now Paramount is back in play. So you have Paramount, which again, like all those people that initially were maybe looking at it, right? You still have Apollo and Sony who had put in a $26 billion offer for Paramount. They're potentially back. But then there's everyone else who's potentially like sniffing around the billionaires. And I mean, you could have a billionaire that just wants, it's kind of like to influence the zeitgeist in the town. They were kind of joking that like, you could have like the Koch family buy it and turn it into a little propaganda arm, which was ironic. Again, I'm a podcast junkie, and I was listening to Kara and Scott on Pivot, who were talking about how it would be fun if they had a lot of money to buy InfoWars and like just again to like mess with Alex Jones, who's like the worst person on the planet, to turn it into a left-wing propaganda arm, just again to be like, screw you.
Well,
but
and on the flip side, wasn't that what Vivek was trying to do with BuzzFeed?
Yeah. Actually, yes. Yeah.
Via his activist stake. But it was written in the covenants or whatever, written in the rules that like, even if you own as much as he does, you don't really get
you don't get a say
content. Yeah. That's what I had read. I'm not sure if that's right.
Interesting. So
it all
anyway,
comes back to Succession though, because
it all comes back to
like
Succession.
what happened with Gawker or what? Not Gawker. What was it called?
Volter.
Yes. I'm like Gawker.
And no, but what was interesting though, actually, and one of the other things that they talked about, I forgot about this. One of the other reasons that they said that they thought that she might have halted everything is that it's potentially hard to let like your family's legacy go, or the assets that your family has owned forever. And they were joking how Rupert Murdoch had no problem with it because, by the way, and this is again in our Succession, like I'm so excited about this course, but in the Succession drama, one of the things that we do is we look at the deal where Disney, by the way, a lot of people might not know this, Disney bought Fox back in 2019. Now they didn't buy Fox News. Fox News got spun off and they sold the majority of the assets. So they sold like $85 billion to Disney. And now Fox Corp, which includes like Fox News and a whole bunch of other stuff, that got spun off. So that is now like a $20 billion company, and that is separate. But it was interesting because like they were like, Rupert Murdoch had no problem. Just like, $2 billion for each of my family members. Like, sounds great. So anyway, I mean, here's the thing that's wild. And I'm sure that a lot of people know this, but it is crazy how much M&A there is in the entertainment media space. It is wild. It's like every company it's like boom, 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 boom. I mean, I'm sure that's like every industry, but it just seems like this industry is like rich with, by the way, huge deals. I mean, the largest deal of all time, actually, I don't know if it was the largest deal of all time anymore, but the deal that resulted in the largest creation of an impairment of goodwill, basically how much shareholder value was essentially destroyed, was AOL buying Time Warner back in 2000. And the showrunners in Succession did say that when they were thinking about the Gojo buying Waystar, that was their model of the deal, was AOL buying Time Warner, because AOL was trading at like 89 times on a PE basis, and they did an all-stock deal and bought Time Warner. But the value of the AOL shares was shit, right? Like ultimately, it's like it all came crashing down. It's like tech bubble. Anyway, so it's just fascinating. I'm so excited about our course. Like the Paramount deal just kind of like feeds into that.
Yay. All right. Well, let's wrap this up. We're going to go struggle with technology for the rest of the afternoon. And as always, we have a phenomenal episode coming out this weekend. It should be a deep dive into PE secondaries, barring any further technological issues that prevent us from releasing that episode. I think it's one of the most exciting and high growth yet least understood corners of the private equity investing world. So stay tuned for that, and we'll talk to you guys soon.
Bye, guys.